Let's go ahead and get into the balance sheet and look at the different components of that. So first of all, let's talk about the purpose of the balance sheet. Well, the main purpose is to show all the company's resources, its assets, and how those resources are funded with liabilities and shareholders' equity at a single point in time. Remember how we were talking about the income statement, how the income statement is within a period of time. So like from January 1st to December 31st, how much income did we earn? The balance sheet is at one particular point in time. So we're saying, as of December 31st, how many assets did you have? What were your liabilities? What was your stockholders' equity? So it's at a single point in time. It's not over a period of time. So the other purpose of the balance sheet is it gives a fuller picture of the company's financial position. If we look at just the income, well, that doesn't tell us everything. We might say, oh, wow, you have net income of $10 million. Cool. Well, but then you look at the balance sheet and you might say, oh, wow, but you have a ton of debt that is going to sink your company in the next year or something like that, right? So the balance sheet is going to give us another piece to the financial health of the company. And then finally, the balance sheet just really helps us understand the solvency and liquidity of the company. Now, those are probably new words to you, solvency and liquidity. But basically, we want to know, will the company be able to continue on next year? Or are they going bankrupt? We are going to look at ways to measure solvency and liquidity in just a little bit, but the balance sheet helps us understand that a little bit better. So let's go ahead and talk about the three main pieces of the balance sheet. On the balance sheet, we have assets, and that is something that the company owns that will provide future economic benefits, or money, basically, right? So think of cash. If you have cash, well, one day that cash will give you a bigger benefit because you can use that cash to buy new technology or develop new technology or buy new machinery or whatever. Or let's look at a piece of equipment. Well, you can use that equipment to produce the widgets and gadgets at your company that you can then sell to make more money. So an asset is something that you own, and one day it will provide future economic benefit. It will produce money for your company, basically. So then we have liabilities. Well, liability is the company's future obligations to either pay money or perform a service. So if I have a bunch of debt, well, that's a liability. So one day I have to pay off that debt. So that's a future obligation to pay back the bank. Or let's say you come to me and you say, Nate, here is $50,000 and I want you to create a course all about how I can become a rainbow unicorn. And I'm like, awesome. Okay, cool. I love rainbow unicorns. Like, let's create a course on rainbow unicorns. So you give me $50,000 up front. Well, I have an obligation to perform a service for you. And so that future service I have to give you is considered a liability. You gave me money, but I still have to perform that service. Or if you think about a warranty, if you take out a warranty on a car or on your iPhone or whatever, well, that's a future obligation that company has to provide you a service. And so that is a liability. And then finally, we have stockholders' equity. Well, that's the amount of equity on the books, not the actual amount of equity, but it's kind of like an accounting term. It's the amount of equity held by the company's equity investors. So what equity is going to entail is the net income from the company. It's going to entail any money that we've raised and things like that. So it's the amount of equity that we have in the company. And when we throw that all together, we get the accounting equation that we talked about previously, where assets equals liabilities plus equity.